Israel struck Qatar, but China has delivered the most damaging strike against the U.S. economy. This strike will hit the U.S. so hard that you can imagine the impact on the dollar and on the investments that Trump has been relying on from the Middle East and around the world. China has driven gold prices through the roof. Gold has shot up to around $3,700 per ounce. Imagine the situation. China's buying gold so aggressively that the price is out of control, severely overbought at an extremely high level. That raises the risk of a global financial shock. So what is China doing, and how heavy will this strike land? Trump is now desperately trying to stabilize gold prices because China and other major players are buying gold. They see a coming storm. As China moves away from the US dollar and increases its gold reserves, it is selling dollars and buying physical gold. Because gold is physical, it cannot be frozen or seized in the same way as bank reserves. That's why countries find gold safer when geopolitical or sanctions risks rise. As China accelerates purchases, others who hold dollars are starting to sell off too. Financial risk grows. For example, countries that previously held funds in European banks or elsewhere may find those assets restricted. They prefer gold because it's tangible. The gold market has become overbought and extreme. When the U.S. Federal Reserve cuts interest rates as Trump is urging it to do, borrowing costs fall, which helps consumers, cheaper mortgages, cheaper credit. But lower rates also reduce returns on U.S. bonds, so investors hunt for higher-yielding, perceived secure alternatives. That pushes money out of U.S. treasuries and into other assets, including stocks and, increasingly, gold. Previously, the U.S. dollar was viewed globally as a safe haven that couldn't be toppled. Now the biggest shock is that the dollar is under severe pressure. Markets are jittery. Gold prices are rising, crypto prices are rising, currencies like the yuan and euro are moving, and investors are unsure what to buy. Normally when trouble hits, investors buy gold, but now China is the world's biggest buyer. Countries such as India, Pakistan, and others see local purchasing drop in some consumer markets, and gold demand at weddings and festivals is being affected. Major players buying gold drove prices sky high. Those trillions earmarked for investment in the U.S., the billions and trillions that Middle Eastern and other investors plan to place in America, are now watching the future closely. If the dollar weakens and gold keeps rising, these investors worry their multi-year commitments will lose value. They may shift allocation toward gold to protect returns. This would undermine the huge investments that were supposed to bolster the U.S. economy. These are not small amounts. We're talking about countries committing hundreds of billions or even trillions of dollars. If that capital starts to flee, it becomes a massive problem for the dollar and for U.S. economy stability. Rising gold prices mean higher inflation expectations. Risk assets like stocks and bonds become less attractive. Investors pivot to gold. Large U.S. companies might start holding reserves in gold rather than dollars. This gold strike is far bigger than the damage Israel might inflict on Qatar. It could severely weaken the dollar and destabilize investments worldwide. If the dollar loses its strength, imports, raw materials, and energy costs will all be affected. You saw that Chinese officials have begun to be openly identified as driving this shift. Gradually, the dollar is weakening, and that weakening will not leave only the U.S. damaged. It will harm Israel's position too, because a weaker U.S. reduces America's global leverage. Many countries currently hold reserves in dollars. If they pivot to gold, the dollar reserve model is undermined. Historically, the world followed the U.S. because the dollar was stable. Now governments are asking whether the U.S. is still that anchor. India has already started significant moves, selling some bonds and buying gold in large amounts. Other major players are following. When Trump sees this, he recognizes that a red line has been crossed. Global financial dynamics are shifting. This is a major economic battle. China has essentially launched a strike on the U.S. by buying gold and eroding confidence in the dollar. Markets are now out of control compared to the past, when the U.S. could manage market shocks and stabilize gold in currencies. Recall 2008 when gold surged. Big long-term investors plan for 5 to 7 year horizons, not just 1 or 2 year windows. They will reposition where they believe returns and safety lie. The bottom line is clear.
You cannot defeat China economically by simple measures. Attempts to pressure China can backfire, and China's gold strategy is pulling the rug from under dollar dominance. If the dollar weakens, the promised trillions in investment may be jeopardized. Those investments were supposed to flow over 10 years. If investors fear a collapsing dollar, they will reconsider. A weakening dollar will raise the cost of imports, raw materials, and energy costs, and will erode living standards. Voters will feel the pain. Rising cost of living, falling savings value, and weakening currency all affect political outcomes, including midterm and presidential contests. So this is a very big problem for Trump. China, India, and other powers are shifting away from the dollar. Over the next 3 to 4 years, this impact will grow and the dollar could face catastrophic losses. The investments that were meant to stabilize U.S. growth may vanish if confidence in the dollar collapses. That is why many countries are now buying gold to protect themselves. China's gold strike is the gravest threat to the U.S. economy right now.
Please share this video as much as you can, subscribe to the channel, and leave your thoughts in the comments so we can include your questions and key points in our upcoming